Welcome back to the Deep Dive. We're here to cut through the noise, give you those essential nuggets of knowledge so you can be truly well-informed. Today, we're diving headfirst into something really foundational if you're interested in the U.S. stock market. That's the S&P 500 index. It's more than just that number you see flashing on the news. It's the benchmark. It's really the heartbeat of American business.
That's absolutely right.
Yeah.
And right at the core of getting access to that heartbeat. That's our topic for today, the SPDR S&P 500 ETF Trust. Everyone just knows it as SPY, the ticker.
SPY, yeah.
And it's not just an ETF. For a lot of people, it really is the ETF. It's the biggest, the oldest, and you could argue the most actively traded one on the whole planet.
Okay, so let's really dig into this then. Our mission today, well, it's a full analysis of SPY, specifically from an American investor's viewpoint. We're going to look at its main features, its big advantages, and also some really crucial things you need to think about. The goal here is that by the end of this deep dive, you'll have a much clearer idea if SPY actually fits with your specific investment goals. Let's jump in.
Let's do it. So yeah, when we talk SPY, the full name is SPDR S&P 500 ETF Trust, ticker SPY. Like you said, everyone knows it. It's managed by State Street Global Advisors, SSGA.
Right.
And its objective is, well, it's refreshingly simple. It aims to precisely track the price and the yield performance of the S&P 500 index. So basically reflect how the top 500 large-cap U.S. companies are doing.
And you mentioned oldest. They really mean it, don't they? SPY launched way back on January 22nd, 1993. That makes it a real veteran, like a pioneer in the whole ETF world.
Oh, definitely.
Think about that. It's been riding the market's waves up and down for more than 30 years now. That's a serious track record, builds confidence.
It really does. And the scale, it's just immense. As we're talking, say, mid-2025, its assets under management, AUM, we're talking hundreds of billions, often getting close to $1 trillion.
Wow.
Yeah, it's not just a big fund. It's like an economic force in itself. Now, what's really interesting for investors is the cost, the expense ratio. It's very low. 0.09% annually.
Okay, 0.09, that sounds tiny.
It is tiny in absolute terms, but it's worth pointing out it is slightly higher than some of its main competitors, like Vanguard's VOO or the iShares one, IVV. Those tend to be more around 0.03%.
Okay, good point. So let's break that down. For you listening, what does this actually mean? SPY gives you direct, pretty efficient access to the U.S. large cap market. And that low expense ratio, even at 0.09, it's still super important because costs really eat into long-term growth, that compounding effect. Pennies saved over decades add up to, well, potentially a lot more wealth for you. And that long history we talked about, that 3 decades plus, it really does build trust in its stability and, its ability to actually do what it's supposed to do, track that index accurately.
Spot on. That's what you want in a passive fund.
Yeah.
Now, if we look inside STY, what's it actually holding? Well, it's almost entirely U.S. large-cap stocks. No surprises there. It follows the S&P 500's method, which is market capitalization weighting.
Meaning the bigger the company's market value.
The bigger its slice of the SPY pie. Exactly.
Okay. And if we break that down by sector, what does that look like, say, around mid-2025?
You see a very clear leader, information technology. It's consistently the biggest chunk, often around 30% of the whole fund.
30%. So we're talking Apple, Microsoft, NVIDIA.
Yep, the tech giants driving so much of the economy right now. Then you've got communication services, usually somewhere between 10 and 15%. Think Alphabet, Meta platforms.
Google and Facebook's parent companies, right?
Correct. Financials and healthcare also tend to hover in that 10 to 15% range each. And consumer discretionary, Amazon, Tesla, those kinds of names, typically around 10%.
Okay.
And of course, it's diversified across other areas too, industrials, consumer staples, energy, utilities, materials.
Yeah.
But those top few sectors really carry the most weight.
Yeah, you can see that.
And it leads to concentration. While SPY holds all 500 companies, that market cap weighting means the top few holdings are, well, they're really significant. As of mid-2025, the top 10 would likely be, Microsoft, Apple, NVIDIA, Amazon, Alphabet, Meta, Eli Lilly, Broadcom, JP Morgan Chase.
A real who's who.
Exactly. And maybe Tesla or Berkshire Hathaway rounding it out. The striking thing is those top 10 names alone can make up 25%, sometimes 30%, maybe even more of the entire fund's assets.
Wow. Okay. So that's a really critical point for you, the investor, to grasp. SPY gives you that fantastic broad exposure to the big U.S. industries, yes. But it also packs quite a punch in terms of sector risk, especially tech and even single stock risk from those giants.
It's a classic double-edged sword.
Right. On one side, that concentration has fueled amazing growth for years.
Mm-hmm.
But on the other, if tech hits a rough patch, or even just a couple of those mega caps stumble.
It can have a really outsized negative impact on your returns.
Mhm.
It's a risk factor you absolutely have to be comfortable with.
Definitely something to keep in mind. Okay, let's shift gears a bit. What about dividends?
Sure. SPY pays dividends quarterly, usually March, June, September, December. As of, say, July 2025, the yield is typically hovering around 1.3% to 1.5%. But that number moves around, obviously, based on what the S&P 500 companies are paying out overall.
So not a huge yield.
No, definitely not. And in terms of dividend growth, it generally just follows the long-term trend of corporate earnings growth in the U.S.
Okay, so the main takeaway for you listening, SPY is not really an income play. Don't buy it expecting big dividend checks. Its main job is capital appreciation, growing your investment value over time.
Correct.
The dividends are a nice bonus, and importantly, you can reinvest them, which is huge for compounding.
Absolutely. Reinvesting even small dividends consistently over many years, that's a really powerful wealth building tool. Don't underestimate it.
Good advice.
Now, let's talk about SPY's operational side,
Yeah.
because this is where it really, really shines. It's liquidity. It's just unmatched in the ETF universe, period. Meaning it has the highest daily trading volume by far. So for you, that translates into incredibly easy buying and selling. You can trade shares quickly, cheaply, and without your own trade significantly moving the price.
Okay, so the bid-ask spreads are tight.
Incredibly tight. That tiny gap between the buying and selling price is minimal. This makes it the absolute go-to for big institutional investors. They need to move huge amounts of money without causing ripples, and SPY lets them do that.
Right. And even if you're not an institution, that ease of trading, getting the price you want when you hit buy or sell, that's a huge practical plus. Less slippage, as they call it.
Precisely. And tied to that efficiency is its tracking error. It's remarkably low. It shows SPY does an extremely accurate job of just mirroring the S&P 500 index. That's thanks to its passive management style and those low fees we mentioned. It does exactly what it promises.
Predictable in a good way.
In a very good way for an index fund. We can also look at fund flows, money coming into SPY versus money going out. Gives some interesting clues.
Like market sentiment.
Yeah, generally. Big inflows often suggest market optimism, maybe institutions increasing their stock holdings. So, for instance, after a strong market run like late 2024 into early 2025, you'd probably see large inflows into SPY.
And outflows.
Usually signal the opposite, market uncertainty, maybe nervousness about interest rates going up or recession fears, people reducing their stock exposure. Right now, mid-2025, given the market's recent strength, you'd likely expect net inflows. But it's always subject to what's happening in the wider economy.
So for you listening, this is like a pulse check on what the big money is doing. It's not a crystal ball, definitely shouldn't be your only indicator.
Oh, absolutely not.
But you can use these public fund flow numbers as sort of a supplementary gauge of broader market sentiment.
Right. And it highlights again that massive liquidity advantage of SPY. It's the vehicle they use. These flows give you a unique little window into institutional positioning.
Okay, so let's tie this all together. We've covered a lot. What are the ultimate pros and cons when you're deciding about SPY?
Let's recap the advantages first. Number one, broad diversification. Spread your risk across 500 big U.S. companies. Reduces the impact if one company tanks.
Okay, diversification check.
Number two, that exceptional liquidity we just hammered home. Fast, low-cost trading at the price you want. Huge plus.
Liquidity, got it.
Three, the low expense ratio. Even at 0.09%, it's low and minimizes that long-term drag on your returns, lets compounding work its magic more effectively.
Low cost, yep.
4, market return tracking. If your goal is simply to get the average performance of the U.S. large-cap market, SPY is designed for exactly that. No trying to beat the market, just match it.
Matches the market. Makes sense.
5, transparency. You can see exactly what it holds every day. It's all public, easy to monitor.
Transparency, good.
And finally, number 6, easy dividend reinvestment. Simple, automatic way to boost your long-term returns through compounding.
Okay, those are some strong points, but what about the downsides or the things you really need to consider carefully?
Right, the crucial considerations. First, obviously, market risk. SPY gives you full exposure to S&P 500 downturns. If the market drops 20%, SPY drops roughly 20%. It's not defensive.
Full market risk. Understood.
Second, that sector concentration risk we talked about. Heavyweight in tech. If that sector struggles, or even just a few of those top giants hit turbulence, It will significantly affect SPY's performance.
Sector concentration, key risk.
Third, and this is subtle but really important for long-term individual investors, the expense ratio compared to VOO and IVV.
Right, the 0.09% versus their 0.03%.
Exactly. That 0.06% difference sounds like practically nothing. But you run the numbers over, say, 20 or 30 years on a decent-sized investment.
It adds up.
It really adds up. We're talking potentially thousands, maybe even tens of thousands of dollars difference in your final outcome just from that tiny fee difference compounding over time.
Yeah.
It's like a silent drag on your wealth.
So for you, the long-term buy and hold investor, maybe saving that extra 0.06% with VOO or IVV is actually more important than SPY's slightly better liquidity.
For many, I'd argue yes. Unless you're trading frequently or dealing with massive amounts where that tiny bit of extra liquidity matters, the lower cost is probably king for the long run.
Interesting point.
And that leads to the fourth consideration, tax efficiency, specifically because of SPY's structure.
How so?
SPY is a unit investment trust, a UIT. It's an older structure compared to most modern ETFs like VOO or IVV, which are typically open-ended funds or regulated investment companies.
Okay, UIT versus RIC. What's the practical difference for me?
The potential tax impact. RICs often have ways to manage their portfolio, like swapping securities, that can minimize distributing capital gains to you, the shareholder. SPY, as a UIT, might be less flexible. If it sells stocks within the portfolio for rebalancing, it might be required to distribute those capital gains out to shareholders.
Even if I haven't sold any shares myself.
Correct. So you could potentially get hit with a capital gains tax bill just for holding SPY, triggered by its internal activity. It's sometimes called a phantom gain.
Ouch, a surprise tax bill.
It can be, yeah, especially if you hold SPY in a regular taxable brokerage account, not a tax-advantaged one like an IRA or 401k.
Uh-huh.
Also, sometimes UITs might handle dividend withholding slightly differently. It's a nuance. But for tax-sensitive investors, it's a real difference compared to VOO or IVV.
Okay, that's a really crucial distinction. So bringing it all home, what's the overall takeaway for someone listening?
We want to give you that balanced view. Look, SPY has incredible strengths. If you absolutely need that top-tier, best-in-class liquidity, maybe you're a very active trader or managing huge sums, it's arguably the best tool for the job.
Its operational edge is undeniable.
Undeniable. But you absolutely have to weigh that against these nuances, the slightly higher costs compared to direct competitors, and that potential tax inefficiency from the UIT structure.
So it really boils down to your personal situation. What matters most to you? Liquidity above all else. Or minimizing long-term costs and potential tax headache.
That's exactly it. You need to know your priorities and your investment horizon.
Right. So in conclusion,
SPY is still an excellent, incredibly solid choice for getting that core U.S. stock market exposure. It's particularly strong, as we said, for those prioritizing extreme liquidity or engaging in large-scale, perhaps shorter-term trading. Its track record and operational mechanics are truly second to none.
absolutely. But for many individual investors, especially if you're focused on the long term, decades of buy and hold, we'd strongly recommend you at least compare SPY side by side with Vanguard's VOO or iShares IVV. Look at the total picture. And please remember, before making any investment decision, always check the latest official fund documents, read the prospectus, look at the fact sheet. That's where you'll find the most current, detailed, and crucial information for your specific needs.
Couldn't agree more. So here's a final thought to leave you with. Considering SPY's decades of proven reliability, its massive size, its role as a foundational piece of the market, does that slightly higher expense ratio really diminish its value for the typical long-term investor? Or do its unparalleled liquidity and its incredibly precise tracking make it almost an irreplaceable cornerstone for pretty much any portfolio, no matter the size or the time horizon? Something to think about.
Definitely food for thought. We really hope this deep dive was helpful for you today. If it was, please do consider subscribing to our show for more insights like this.